Yes, good afternoon, friends. Modi sir, please start your video. Akshay Modi sir.
Yes. Am I visible? Am I visible?
Yes, sir.
Okay.
Yes. Okay. Good afternoon, friends. On behalf of Maharashtra Tax Practitioner Association and All India Federation of Tax Practitioners, Western Zone, a very warm welcome to all the tax professionals joining us today. Today's webinar on Union Budget, the Expert Decoding. To begin the first technical session, I would like to formally call upon as the dignitaries, President of our association, Advocate Anuruddha Chauhan sir. I request them to please escort today's faculty, CS Suhas Bora sir. I also request session chairman of this committee, Advocate Narendra Sonode sir. Secretary, Advocate Pranav Shet sir, please come on dais. And the committee member, Milind Hendry sir. Also, I welcome the president of AIFTP West Zone, CA Akshay Modi sir, on virtual dais. Yes. I request our immediate past president, Advocate Prasad Deshpande sir, please come on dais. Yes, please. To begin the proceeding of the today's technical session, first of all, I invite our chairman, Advocate Narendra Sonali sir, for his opening remark. I request Narendra Sonali sir, please come and give the opening remark.
Good afternoon. The Union Budget is not merely a fiscal document. It's a legislative expression of economic philosophy. Its true meaning emerges only when professionals interpret the law beyond the text, by understanding its intent, structure, and long-term impact. With this perspective, a very warm good evening to all of you. Respected President of FTPA, Advocate Anuruddha Chauhan sir, respected Chairman of AIFTP West Zone, CA Akshay Modi sir, respected Co-Chairman Shilpa Bedarkar, all our esteemed faculty, CA Suhas Bora sir, respected seniors, colleagues, and my dear professional friends. On behalf of AIFTP West Zone and MTPA, jointly with MTPA, it's my proud privilege to welcome you all to this webinar on Union Budget 2026-27 Expert Decoding Budget. Friends, for tax professionals, the Union Budget is far more than a statement of figures. It's a framework of rights, and responsibilities, a foundation for compliance and advisory, and often the starting point of interpretation and litigation. Every section, proviso, and expression has the potential to influence business decisions and taxpayer confidence. The budget 2026-27 has been presented at a defining stage of India's economic evolution, where growth ambitions must align with fiscal discipline, digitization, and certainly in tax administration. In this context, our role as a tax professional becomes both intellectual and as well as ethical. We are expected not merely to apply the law, but to understand its spirit and to guide taxpayers with clarity and conviction. Today's webinar is therefore not just an academic discussion, but an exercise in professional preparedness to help us interpret the law correctly, advise responsibly, and plan strategically. We are indeed fortunate to have with us two distinguished experts who bring together deep statutory understanding and rich practical experience. Their insights will help us to move from what the budget says to what the budget truly means for our professional practice. Having appreciated the budget as an instrument of economic policy and professional responsibility, the next logical step is expert interpretation, and that is the best achieved when learning comes from those whose analysis blends legal precision with practical wisdom. With this, I now have honor to inviting C.A. Suhas Bora sir to kindly guide us through the direct tax proposals for the Union Budget 2026-27. Thank you very much.
Now I request, thank you, Saran sir. Now I request President Advocate Amrut Chauhan sir to address the gathering. Today's faculty, say, Suhas Bora sir, Chairman Narendra Sonal sir, IPP Prasad Deshpande sir, Committee Member Indra sir, Secretary Pranav Seth sir, say Akshay Modi sir, Co-Chairman say Mebeder sir. Good afternoon, everyone. A very warm welcome to all our members, esteemed colleagues, and fellow tax practitioners joining us from across Maharashtra and West. It is a privilege to see such a strong turnout for today's webinar on the Union Budget 2026-27. Every year, the Union Budget brings a mix of expectation, questions, and a fair amount of paperwork. For us as a professional, our job is not just to read the law, it is to decode it. We are a bridge between these national policies and the common taxpayer. Today, we aim to cross the bridge together. We are incredibly fortunate to have two stalwarts with us today to lead the discussion. C.S. Bora sir will be guiding us through the intricacies of direct taxes, and Dr. C.A. Dilip Satbhai sir will cover the other major shifts and changes. Their expertise is exactly what we need to turn these complex causes into clear, actionable insights. I also want to thank the All India Federation of Tax Practitioners for partnering with the Maharashtra Tax Practitioner Association to host this event. When our associations work together, our collective voice and knowledge become much stronger. I encourage you all to be active participants, ask questions, engage with the experts, and let's make these next 3 hours highly productive. I officially open this session. Let's dive into the budget. Thank you. Thank you, Chauhan sir. Now I call upon the President of AIFTP West Zone, C. Akshay Modi sir for his presentation. Modi sir, please.
Good afternoon, everyone. Very warm welcome on behalf of both the associations to senior professionals, participants joining across the country, mainly from the West Zone. As the chairman of All India Federation of Tax Practitioners West Zone, it gives me immense pleasure to make a collaboration with MTPA. We have made many collaborations the year since the COVID period. We have much more collaboration. It is increasing day by day. With that collaboration, the quality of program is also increasing, the participation is also increasing, and which makes the educational program and knowledge sharing worthwhile and much more important. Regarding the budget this time is like retrospective amendment budget. Mainly, more and more retrospective amendment has been made in the direct taxes, which is in favor of the revenue. This government does not have the guts to accept the defeat even through judiciary. Every time judiciary defeats them and they are coming with the circular notifications and retrospective amendments. So I am not here to discuss the budget as the esteemed faculties are here to discuss that. Both the faculties are very eminent to discuss the budget. I welcome both the faculties, C.A. Suhas Bora sir and Dr. C.A. Dilip Satwai. I welcome all. I welcome both the faculties on the behalf of both the association. And I will not speak much, and I will request the host to kindly start the webinar on budget. It is very helpful to all the participants. Thank you. Thank you very much.
Thank you, Modi sir. Thank you to all leadership. Now we will move to the first technical session. First of all, I invite Mr. Milind Hindre sir to introduce our first faculty, C. Suhas Bora sir.
Thank you, sir. Honorable President of FTPA, Advocate Honorable Chavan sir, President of AFTP, Chairman of AFTPA Zone, C. Akshay Modi sir, today's faculty, C. Suhas Bora sir, Chairman Advocate Narendra Sharma sir, all the dignitaries on the dais, senior members and past president on this Zoom platform. Today, we are very fortunate to have faculty CS Bora sir for this important topic of budget 26-27. Sir is in practice since last 38 plus years in the field of audit, direct taxes, indirect taxes, company law, and RERA. Sir is a founder member and senior partner of STCM and Associates. Sir has also empaneled as a quality reviewer by Quality Review Board of ICI, empaneled as peer reviewer by Peer Review Board of ICI, honored to be a member of Fee Fixation Committee of Bharati Vidyapith University for the years 2009 to 2011 and 2014 to 2016, appointed by University Grants Commission, New Delhi. Sir is also accrued valuer and fellow member of Institute of Valuers in category of stocks and shares. Also accrued valuer appointed by Income Tax Department under Section 34AB of Income of the Wealth Tax Act. Sir is member of various committees of ICAI since 2018-19, such as capacity building of members, direct taxes, chairman of member of managing committee of Pune branch of WIRC of ICAI in the period 95-97, Pune Governing Council and Confederation of All India Traders, CSL of GISO, Pune chapter. Regular paper writer, sir is a regular paper writer for articles to be published in newsletter of professional and trade organizations. Sir is a regular faculty in various seminars on topics related to taxation of real estate, joint development, income tax, planning and investments, family arrangements and HUF, tax planning, wills, appeals, GST, sales tax law, VAT audit, law related to trust and service tax laws. Also renowned speaker in the field of time and stress management, key to access in profession and other motivational and spiritual subjects. Sir is also a founder member
an active faculty of Pune City Study Circle and also regular faculty of Pune branch of WRC, Maharashtra Tax Practice Association, AFTP, Bombay Chartered Accountant Society, etc. So is active member and also advisor for various social and charitable institutions such as Jito Pune, Pune Panjarapoor Trust, Maharashtra Saraf Association, Federation of Trade Association of Pune, Tradai, Pune Merchant Chambers, etc. So with this short introduction, I request you all to please welcome sir with big round of applause. Over to manager sir.
Thank you, sir. Now I request our President, Advocate Honorable Chavan sir, to please felicitate CSO as well as this faculty. Thank you, sir. Now I hand over the session to CS Suhas Bora sir for his expert analysis on the budget. Bora sir, please. Yes.
Good afternoon to all, my colleagues, my partners, associates, and my professional friends. At the outset, I sincerely thank AIFTI Western Zone, Maharashtra Tax Practitioner Association, especially Advocate Anirudh Chavan, President, MTPA, CA Advocate Akshay Modiji, Chairman AIFTP, West Zone, CMA Sri Sripad Bedarkarji, and Advocate Narendra Sonalji for this kind invitation. And it's very heartening when Sonalji shared with me, sir, this is your 10th consecutive presentation on the budget. It's really privileged. It's privilege and honor to address a forum where tax law is not merely discussed academically, but also applied, interpreted, and lived every single day. This platform is particularly very close to my heart. It's like a mother association when I started my profession. I have been associated with this association for almost more than 45 years, and now over a decade. I have been given this opportunity of presenting my views on the direct tax proposal in the budget every year. But as I said, equally discussion from this forum, the queries which have been raised, the issues which have been addressed, the representation which has been made by the association and all the office bearers since last decade, I'm saying, everyone has been enthusiastic, and it only reflects the strength, legacy of our professional institution. Friends, budget 2026 is historic in more than one ways. All of you know, it is first union budget presented on Sunday. Also the 9th consecutive budget presented by India's first woman, Honorable Finance Minister. This continuity at the helm reflects policy confidence, administrative stability, and long-term thinking. Friends, this budget also carry forward our Honorable Prime Minister Modi's 3-0 vision, Badani Hai Global Pehchan. It's a budget driven by Yuva Shakti, global ambition, and institutional maturity. The day before the budget, there were expectations, and when the day of the budget we entered, we all having a big expectation of there will be bold tax rate changes or meaningful relief to the various sections of the society, and especially small traders, salaried class people. However, budget 2026 is rather has largely disappointed on that front, and perhaps the reason lies in the larger transition which we are currently witnessing. Friends, we are at a historic crossroad in the direct tax field. We are about to bid a farewell to the Income Tax Act 1961, which has governed us almost 64 years. Before that, 1922 Act also lasts nearly 40 years. And now we have Income Tax Act 2025 scheduled to come into force from 1st April 2026. Before I go further, let me share in a lighter vein about the discussion when it started about Income Tax Act 2025, and in the morning groups, many occasions, it was discussed that probably this time, this Income Tax Act, maybe with the support of AI, is going to come. And all were very happy. Now Income Tax Act will be simple. But after reading Income Tax Act 2025, all of us will agree with me that probably that AI, which has been machine, I can say, used for this 2025, must be trained in the amendments and notwithstanding and all those phases which have been there to work. One of our legends in the profession has very aptly described it, and it's very beautifully said. 1961 Act was put in the AI machine with the instruction: no alphabets, no clauses, no proviso, no explanation, no notwithstanding, and reorganize the law into the neatly chapters. So all were in that mode. And what has emerged is 1925 Act, which is, in my humble view, it is like old wine in the new bottle. For last 2 days, night and until this afternoon, my SPCM team and I have been grappling with only one challenge: how to correlate old provisions, new provisions, and the budget proposal. We have been told that our 1961 Act is complicated, and therefore 1925 Act come. If you see, Finance Bill itself runs into 222 pages. For the first time, we see there are 23 amendments to the old law, 87 amendments to the new Act, which has yet to born. 2 sections are omitted, 9 substituted, and 87 amendment, meaning almost 20% of the new Act, which has a 500 section, is already been rewritten. And we were told that old Act was complicated and new Act has to be simplified. Why old act was complicated? Because it was so many explanations, so many proviso, so many notwithstanding, so many sub provisions, redundant provisions. And if you see that in 2025 Act, to my surprise, 30 sections relating to deductions and exemptions have been as it is carried forward in 2025 Act also. And one classic example, if I give, I just wanted to bring to your kind notice, probably many of you are in the profession in 90s. In 1993, there was a provision introduced for clubbing of minors' income in the hands of the parents who are having more income. And there is a small exemption has been provided of 1,500 rupees. Same 1993, 1,500 rupees, and 2025 Act, it is same 1,500 rupees. Probably a machine must have been given instructions to remove those, not to touch figure, so that 1,500 remains still remain 1,500. Forget about the inflation, but what is this? And as I said it, if we have 20% lorry return, what is the fate of it? And therefore, naturally, the expectations were high. There are at least some meaningful relief must have been given to the particularly salary class people having some increase in the standard deduction, just to account for the inflation. And all of us will agree with me that there is an inflation in the entire year is concerned. Interestingly, when I was going through the budget, I find that first time the budget uses the phrase ease of living. And when we examine the direct tax proposal, out of 7 so-called relief measures, 6 relate to only ease of compliance and is not ease of. The only substantive relief which I could see in the budget proposals is tax exemption on the motor vehicle accident tribunal interest. With this background, I now proceed to examine the direct tax proposals, which I would like to share with you all today. And I will start with the first only, which has been the only relief which I feel to be given is that it's a complete tax exemption on interest for motor accident compensation. This finance bill has introduced a landmark relief. This has been the only relief which I find in monetary terms. Why it was necessary? There is a background. The background is there is a legal process to claim compensation when somebody met with an accident under Motor Vehicle Act. And Motor Vehicle Act is also of 1988, is often protracted, resulting into accrual of interest to the victims, legal heirs, and when that interest received, it becomes such a lump sum amount, huge amount, for which it amounts to tax liabilities there. And therefore, clause number 108 has been introduced, a vital amendment to see that if such interest will be exempt. And simultaneously, when interest is exempt, TDS provision also been amended accordingly. But what is crucial to be noted, this relief is only for individuals, not other person. So, someone very jokingly said, one of my colleague only in the office, when we are discussing this budget, he said, if we want to claim relief on this provision, first I have to buy a vehicle, I have to buy a motor, I have to learn driving, I have to dash someone, I have to file a suit, I have to, when I make a litigation, then the tribunal will make you award, then interest will be received, and then it will be claimed as exempt. So this is what ease of living frame. That takes me to another provision under this category is employees' contribution to the PF. Yes, it was a very hot requirement, since we are all aware, even if there is a delay of 2 days also, because all we are been in 1961 Act, which we have been knowing, this employee's contribution has to be paid as per the provisions which are under the respective act. And those are the due dates are different than 139(1) due date. This is a welcome provision to satisfy why? Because there may be some reasons, somehow it is not been, the intention is not to give any benefit to the employers. But if by chance they remains to pay in the due date which have been there, then because under those act also, there are penal consequences if they do not pay in time. But at least Income Tax Act, now there will not be disallowance if it is paid prior to due date of filing of return under section 139 under old act. I will not mix up with the new act provisions because there will, if I start doing that, I may be missed out something. Very honestly, I should say ki 2025 act, it's still not habit to us. Why I'm saying this? Because in a gathering also, if I ask ATC, even a article student come to my office, he will also respond it. It's only a LIC premium saving clause has been there. If I refer 87A, people will say it's a rebate which we have to calculate. If I refer 24, this is income from house property. If I refer 44AD, they will say presumption of accession. But that will not the case with a new act because it is 500 section with different things to work. So we are not accustomed to it also. Therefore, in my today's discussion also, even though, as I said it, there's old wine in the new bottle, provisions are likely same. So it will be the principle which I will be discussing with reference to the 1961 Act, which I know going to be die on 31st March itself. But all of we professional, we will have to learn this for next 5 years, minimum. And therefore, I said, is this provision is a ease of living or ease of compliance? It's a ease of compliance. It cannot be ease of living. That may take me to another provision of nil or lower TDS certificates. Friends, we know what we are facing if we want a lower deduction or nil deduction certificate. Right now, what we have to do, we have to file an application. We have to wait for AO's appointment. We have to manual verification of the evidences which we need to give. We have to do follow-up. And finally, either to get certificate or rejection. Two new realities what? Now you have to only automated processing going to do, instant approval if conditions are met, or instant rejection if conditions are not met. So what is that? Because it says, if we want to be income, if you have below taxable income or if your income is exempt, then you need to only apply automatically and then you get a deduction of certificate. And this benefit to all the small taxpayer, senior citizens, individuals, which are having income below taxable limit. And those are been really eligible for the exemption as concerned. Current process is tedious and cumbersome, time consuming. This new process, if you fill up the form correctly with all requirements, then probably you will get those certificates very easily. So it becomes significant. Those other forms and eligibility conditions are yet to come because rules will come. Then only we will be able to know this. But it will definitely have, if come into effect from 1st April 2026. So lower deduction certificate, which we wanted for this March, we need to make it in the old process. And the new, it will from the 1st April to work. First time in this budget, I see, normally FAQs come later on. This time, SET itself contained the FAQ on each the provision. And they have very nicely described each and every aspect in the FAQs to work out. Third, which I find it in this series is no TAN required for buying property from non-resident. Friends, all of us, we are knowing if we are buying property from non-resident, then we need to do the TDS. And then that for that purpose of TDS, we require to have TAN. When we have a TAN, we have to go cumbersome process. Now, they are saying, we don't require, like a resident, you buy the property, with your PAN you do TDS. Here also, with your PAN you can do TDS very easily. And unnecessarily, a doubting of integrity of that NRI on us we are saying, can we apply? In my office itself, 1 month before, there was a lot of hassle in getting the TAN numbers for that person. And property used to buy, it was 15 days carry. That NRI person from USA, he was just saying what is going on, what we can explain. Our process is such, we will not able to make out. Otherwise, we say we'll pay, deduct 20%. Why you want to make it? But there also, he wanted, why you are not paying? If I don't have TAN, how can I pay? So this was the situation, but this will be now eliminated. Simultaneously, we will have all the TDS and TCS provisions also been simplified, and especially the TCS rate, which is on the tour packages. All of us, even Sonones sir also will be happy, saying that he also wanted to have every time RRC at various global places, and then that issue of the TDS also question comes in mind. Now it has been substantially reduced. So members will be more there for you. You don't have to make any invitation. It will be hijacked to work out. And for that, there is no threshold limit. So there is no issue on that. So it has been straight away from 2% when it comes. Otherwise, for 5% or 20% maximum. And therefore, people were hesitant. Same TCS rate also for LRS remittance also, but there is a threshold limit. Threshold limit of 10 lakhs rupees rather you can say. And for providing it, we need to work. Another that ease of living provision is rule for manpower supply. Rule for manpower supply, there is always been litigation, whether it's a professional service or a technical service or it's a contract. That dichotomy has been removed with this proposal. Now the manpower supply is included in the work under section 194C of old act. New act probably 402 or 407 section will be there to work. But what will make it that? It means supply of manpower to a person to work under his supervision, control and direction. And with this insertion, now TDS on the supply of manpower will be governed by contractor provisions which have been there. Old act, it is 194C. New act may be 400 or 393 or odd will be coming. Similarly, now the nil deduction or low deduction also will apply for this provision, because for the 194C, that provision has already been there. This provision also effect is again 1st April 2026. So we have two acts. Up to March, if we are making manpower, it will be under technical services. After March, in April, under new act, it is a contract service. So every time we need to always be filled with 61 Act, 25 Act. That takes me to a friend, revised ITR filing window. This budget 2026 gives transport more time to file revised return to correct mistakes. Current time, as we are knowing, it's a 9 month, and extended time is now 12 months. It has been, like I said, it's a corresponding provision of old acts is 139.5. What you can revise? You can revise income omission. You can revise deduction errors. You can revise exemption claim. You can revise loss. You can revise any wrong particulars which you find. For Income Tax Act 1961, effective date is 1st March, probably Act will pass before that. And for 25 Act, it is effective date is 1st April. But filing of fees is attached. See, this all last 6-7 years, we find that wherever possible, they try to attach a filing of fees with anything you are claiming extra. When you are claiming extra as a benefit, government is going to take a fees from you. And here also, they make it a liquidative fees of, if your revised income is less than 1 lakh rupees or less than 5 lakhs rupees, then 1,000. And if it is income is more than 5 lakhs rupees, it will be 5,000, which we need to do. Here, your original return as well as the belated return also can be revised. This is the beauty. Then all of us, we are knowing there has been all the time for all of us as a professional, a due date extension requirement, and our office bearer has always been flooded with the request, make it application to CBDT for making of those. So there, some relief has been given where only a date for the class of people whose books of accounts are not audited, and the trust and the partners and the spouse of such things, whereas now due date has been extended to 31st August. 31st July date is for the other people, and remaining dates have been the same. So salaried individual filing ITR is July 31st only, and other individual filing ITR or a trust will be 31st August over. Why this change they made out? This says the reasons which have been quoted are to finalize the books of accounts of those SSC, meeting compliance requirement, because many occasions TDS has not been paid, it's not reflected in 20 days. We are been bound with that. Then, and reducing last minute rush and grievance. Now extending these type of SSCs, I don't think so. There is a last rush which we need to do. But as it is, but this is also a welcome provision to work. Simultaneously, updated return is a concept which has been brought in. The few years before it has been there, and it is good. But what has been there, that updated return also, we have to go with the fees. We have to go with additional tax liability. And they have given category wise, it's a 12 months, 24 months, 36 months, 48 months, and then additional tax liabilities were out is 25%, 50%, 60%, 70%, and even reduction of loss is also permitted now, which was not there to us. There is one more beauty in this provision is that now even if you received a notice under section 148 for reassessment of old act, new act notice will be 280 or section. There also, once you receive the notice, you have an opportunity to update your return. But there you have to pay plus 10% additional tax on each category. So when you are making this in 12 months, it is originally it was 25%. Here, once you receive the notice, it will be 35%. Like that, 35%, 60%, 70%, go on that. So everything with the additional cost. We always, in the first time when I speak, when the GST came, I said, in this government, there is no free lunch. Same way, in this, under Income Tax Act also now, they are shifting mode. Anything you require extra, you need to pay it further. You have to compensate it further. That takes me to the another important provision as regarding penalties. We are knowing that under the existing law, there are two tier penalty, which we come across. I am not discussing all the provisions, but I will be discussing with 270A provision, which we require to deal with every day and day out. One is under reporting of income, and second is misreporting of income. Under reporting of income, we know it's a 50% of the tax amount, and those are been only calculation errors, missed atom, or while filing has been, that penalty has been levied only on when you file the return, and under 143(1)(a), some adjustments are made, and there is a change in that assessed income and the return income, you are liable to penalty of underreporting. And for misreporting, there are false claims, misclassifying of the income, providing faulty information, and one more category has brought in this now are unexplained cash credit, unexplained borrowing, and all those old section 69 category of it, 69A, B, C, D, E, and plus that cash transaction about 2 lakhs rupees. Those have been part of it. This been also been added under misreporting of income. There, immunity also work, and immunity also provide both the provisions now. So immunity is what? How you can pay? You have to pay 100% of the additional income tax and get immunity from penalty and prosecution. So whenever there is been underreporting, you pay tax what has been determined, and then you can apply for immunity. They will make out. When there is misreporting, you need to make it 120% of the tax amount, and then you have immunity from the penalty and prosecution. This immunity is not available if prosecution has already launched under chapter 22 of the old act. Friends, as I say, when I was discussing on the penalty provisions of 270A and A, I must say that for having immunity, what is required is that you must pay all tax and interest as per assessment order under section 143(3) under the old act, or reassessment order under section 147, read with section 143(3) within a period specified in the notice under section 156. That is most important. Then penal circumstances 279 apply only when 100% tax on underreported income as additional tax within a demand notice period instead of facing a penalty. So application for such immunity must be submitted within 1 month from the end of the month in which relevant order is received. So your appeal, you need not to file an appeal also. And again, he has to require, assessing officer required to grant immunity only under section 270A and from prosecution under section 276C and CC. So immunity or waiver will not be granted if proceedings under chapter 22 has already commenced under the old act. Similarly, same will be for the new compliance. We are knowing that there is a penalty for non-compliance or non-furnishing of tax audit report within a due date. And that penalty also be there, which we know that after turnover 1,50,000 is to work. This, now they are shifting. They are saying, now you will have to pay a fixed fine. What that fixed fine is, if there is a non-submission of audit report, is delay is up to 1 month, it will be 75,000. If the delay is beyond 1 month, it is 1,50,000. Similarly, for furnishing accountant's report under 172, it is again delays. If it is for 1 month, 50,000, and for subsequent delays, it is 1 lakh. Now payment of such fees are compulsory. It's like same under the GST regime. Interestingly, a question has been raised to me in our discussion, whether such fees which have been paying, whether it can be a allowable deduction under section 37. Naturally, because it's a fee now we are paying, it's not a penalty, that question arises. But when I see that there is a provision under the Income Tax Act, Finance Act 2024, that number 2 act which we have seen after the election, each contained a proviso which says any expenditure incurred by a taxpayer for settlement of proceeding initiated in relation to contravention of default shall not be allowed as a deduction. All those fees which we are paying is a contravention of the act. And therefore, to my mind, this deduction will not be allowable under this cap. So if you see from this penalty under what they wanted to do, they are changing charge of penalty instead of impact of rights has been diluted when you are going straight away. So there is been philosophy which has been developed is what? Discretionary penalty has gone. It's a fixed fees you have to pay. There is no question of litigation. There is no question of mens rea. There is no question of even a reasonable cause. There may be possibility that something happens to that chartered accountant or that family assessee, medically something happens, still in that case, there is no dilution. There is no waiver of fees, no provision, which I find out in even 2025 Act. So that failure, now they are shifting is from the penalties, which we have opportunity to show. And in many cases, we find, in many cases, that penalty has been knocked down by the tribunal. Because question of mens rea, always there can be a reasonable cause, but that is gone. There is nothing now. It has been said that they have rationalized provisions of the prosecution. And I must read it, the memorandum, why they are saying. They are saying, and what is the reason? It's very interesting to read out exact wording. I'm reading from the memorandum. It says, in this regard, it is proposed to amend that section I'm not reading. Continued exercise of the decriminalization. This is the new concept which came. Decriminalization, and to make the punishment for the offenses mentioned in these sections proportionate to the crimes. So you are saying crime also there. The principles that are followed in the proposed decriminalization exercise are as follows. What they are saying: the nature of punishment is changed from rigorous imprisonment to a simple imprisonment whenever prescribed in the section mentioned above. Maximum punishment is proposed to be limited to 2 years from its current 7 years, and for subsequent offences, it is reduced to 3 years from its current 7 years. When punishment of offences is prescribed based on certain grading of the amount of tax evaded, new grading of offences and its corresponding punishment is prescribed. For amount of tax evaded does not exceed 10 lakhs rupees, punishment of only fine is prescribed. Imposition of fine is introduced in addition to the imprisonment, and certain offences are fully decriminalized. So if you see what is their rationalization, they are saying they have rationalizing of prosecution proceeding. See, all those provisions when we see, we find that jail jana pakka hai. Only sakta muzuri pasun simple ह्याच्यावर. So there is nothing rationalization. What is being rationalization as such? But yes, certain they have defined there is a complete decriminalization, and those offenses no longer require now prosecution. Those are failure to produce books of account or documents. When we come across in the faces also, we require to submit various documents. Then non-compliance with TDS payment requirement on payments in kind. Many occasions, payments in kind, we need to make a TDS. Those only 2 items, they have fully complete decriminalization, they made it. This is the new concept. Like ease of living is concept, decriminalization is one more concept. Only these 2 which I find. And then other things have been rationalized with from rigorous imprisonment to the simple imprisonment. So all those have been there to work. And for the taxpayer, we have to see there is a shift of philosophy, nothing more. Government is now moving from a deterrent-based approach to compliance-focused framework. So practical impact, reduce the fear of criminal things. Rather, we say that, all of us will agree with that. If somebody is doing a criminal act, he should be punished like criminal only. But it should not be for all the people to work. But now what we are giving, that fear has been gone. It's only going to the jail. It's been the only to work. But yes, with that, for small taxpayer, there is definitely a relief as such from those, because even then we have seen in last year in Pune itself, for a TDS default more than 1 lakh rupees, there were rampant prosecution provisions. Proceedings were initiated. And once it is initiated, we know what that trouble that SSC has, what the trouble that consultant has to go ahead. So we have to see the bigger picture. There is a provision of compounding also that is continued. So if we do not want to make out that, compounding provisions have been there, but compounding is my experience. My associate Vidhi has been here. She is knowing when she calculated compounding, it required 3 days to compounding provision, how to apply. And after that also, there are so many queries which comes. So it's been compounding also, and compounding again, once you do it compounding, you can do once in life. If you do frequently, that percentage goes more. So instead of it is better to borrow and pay and not to do. That takes me to a very important provisions from the corporate angle is MAT. All we are concerned with the MAT. There has been collection of the MAT, carry forward of the MAT, how we'll get it. And surprisingly, there is no change in AMT. So we are fortunate. AMT is still on the same line. But MAT, they change it. And in a speech itself, when Honorable Finance Minister says, now they are saying final tax. So what the companies which are in new regime, if they are following MAT, they have to pay 14%, forget, no further credits to them at any time. But what happens to the earlier accumulation which is there with me? But that is also, credit is applicable only in case of a company who are opting new regime. That credit is given to them. That too, only 25% of the tax of liability of that year. And that's 25% per year you can make it, subject to you have a legal MAT credit available with you. In a numerical example, if I have to say, it will be, if your tax liability is 100 rupees, you can maximum, if you have MAT credit available, 25 will be reduced, remaining you will have to pay. And that will going on till 15 years to go. For foreign companies, that setup will be difference between normal tax and MAT is continues to have. So it will be only this now tax year. Tax year is 25-26 again. Now we have to forget assessment year. It's a tax year which we have to speak. So impact of this provision is all the time. The companies with low or no MAT credit, they have no issues. They have to opt with 22% tax. For what we as action we required, we have to strategically plan what is MAT credit available, what is number of years available, and how we will be able to guide that client to see that maximum accumulated credit can be finished up as early as possible. That takes me to a provision on sovereign gold bonds taxation. I believe I only have given opinion on this, on the existing law. If you see existing law, when those bond came, it says at the time of redemption, if you are being the holder, you need not to pay capital gain tax, it's exempt. So some of enthusiastic SSC from my client, they made it doesn't contain if I change year between, and if I receive that, again it's exempt. Yes, it was a loophole, definitely. It's still somebody has to do before 31st March, you can do it. But now they curtailed down straight. They said on these bonds, exemption is available only if you are original holder and you are a recipient at the time of redemption. So in between, if you purchased, it will not be there to work. And FAQ 54, they have given FAQ on this, which I will very nicely they have tabulated. I must brought to your notice that tabulation. They says if those bonds, if purchased at a time of issue and held till maturity, then exempt. If not purchased at the time of issue and held at maturity, it is taxable. It is purchased at the time of issue but not held till maturity, taxable. If neither purchased at the time of issue nor held till maturity, because in between you purchase in the market and dispose of, it is taxable. So originally till 30, and this provision is fortunately from 1st April. So 31st March, if somebody has those bonds, they can plan the affairs in the manner what is required. But this is a loophole which I must brought to your notice. Then how it is going to work? Again, if it is exemption not available, normal capital gain provisions of 12.5% right now, with benefit of indexation, not indexation, you have to calculate and do it to work. There is every budget we are saying there is some scheme which come. This year also, there is a scheme which came, and now we are trying fast DS. Fast DS is foreign assets of small taxpayer disclosure scheme. Many of us in Pune, we noticed there are rampant provisions, rampant notices come under the Black Money Act. And those were for what? Either people have not disclosed foreign asset or they have not disclosed the income when they are resident, non-resident, and not only resident. All these categories, we need to, if you have a foreign income, we need to discuss. Even if you non-resident, you need to file a ITR for the year income which you earn in India, and there you must give a declaration in the form. There has been a particulars about asset which you are holding, income which are there, even if you are paying the tax in that country. And so many such failures have been noticed. People forget, people saying bona fide belief on that line. So now they have come with a scheme for such small taxpayer, like a student. Student also go there, they work, they get some income, they invest, they get certain dividend, and they do not inform here. That is, so relocated NRIs also be the same way, or migrating NRIs which are coming. There are so many which these are the provisions for them which is applicable, and it's only one time 6-month foreign asset disclosure scheme to disclose income on asset to a certain size. There are two categories of people who did not disclose their overseas income or asset, and who disclosed their overseas income, paid taxes due on that, but could not declare the asset acquired. So both category they need to do. For category A, amount payable is what? And the limit is that if the undisclosed income or asset is proposed to be up to 1 crore rupees, they need to pay 30% of FMV of the asset. There are rules which have been provided how to make out FMV valuation, and then 30% of undisclosed income or 30% and 30% as a additional income tax in lieu of penalty would thereby get immunity from or other rigorous provision. And category B, that is who disclose their overseas income and or paid taxes due but could not declare the asset, such people asset value is proposed to be up to 5 crore rupees. Here immunity from both penalty and prosecution will be available with a payment of rupees 1 lakh, because they have known source of income which has been disclosed in that country where they are working, and they have paid the taxes. Only thing it is not informed under the Indian Income Tax Act. Then they have to make the payment within 2 months from the date of determination. And if for certain reasons it appears that the scheme is not applicable, then all the rigors of PMLA as well as Black Money Act are applicable, and he has to face the music in that. There is one more, a new concept has been brought by in this budget, is assessment and penalty. So they find why this is, okay, now what is the current procedure? They do assessment, we file appeal, then we request to keep in penalty proceeding abeyance till the decision of the first appeal, second appeal, because assessment not finalized. Many times those additions are knocked down, so penalty provisions will not work. Sometimes they listen, after CIT appeal, if it is confirmed, they levy the penalty. Again, we file appeal against penalty also, and we succeed. And out of, it's our experience, out of 100 cases, almost 90 cases additions made are being knocked down. So penalty will not be levied with that. But now they are saying there is a lot of energy waste, lot of time goes, there is a lot of litigation which is in there. Therefore, they will pass assessment order and they will also pass penalty order simultaneously. It's been a Herculean for me. How it will going to work? What will be if I have that reasonable cause? What will be that what going to work? For that, what they says come out. They said, what we will do, up till now we were asking 20% of the tax demand which has been there. We will not ask you make any payment for the penalty. We will ask you to make payment of 10% of the core tax, excluding interest. So that is the benefit which they are passing, to say that penalty and assessment order will pass simultaneously. So once we are saying we wanted to come out of with the discretion of the officer. Here we are giving him one more tool in hand. Both. And now penalty, once it is in assessment level, it cannot be under reporting. It has to be on the misreporting. So 200 penalties stored is there. And you want to imagine what is the scenario which we are going to face. So there, my suggestion, rather for me also, I finding that the penalty, is it the right of the SSC has been got away? Yes, we are saying for that audit penalties, there has been a fine, there has been fees. But this penalty, there is no fees. It's been under-reporting and lot of. So what is going to happen? They are saying that SSC must know what can be outcome of his assessment. So for that SSC, day of assessment only, he should die. Because assuming that there is a crore rupees addition, 30% is the tax bracket. So 30 lakhs rupees is the tax amount. Interest they will calculate. And penalty is how much? 200% of that. And if I have to go for immunity, I have to pay 120%. Because 270A, it is eligible now under reporting or misreporting, both are eligible for the purpose of immunity. So paying 120% means what? 30 lakhs into 20% further. And I should not file an appeal. So even that addition has been there, which I can contest, penalty has been there first day itself. So all the time you are knowing there is a demand of this much amount. If I could not succeed, it will happen like this. So this has been something which I find the provision which has not been required to be in the act, and the reasons given are been not correct. There is one more clarification provision came. All of we are knowing in all our nearby villages, there has been a lot of infrastructure development is going on, lot of acquisition of land is going to happen, and TDR is going to come. That the act which is always that pronunciation for me in a short form is very difficult to make out. It's a right to fair compensation and transparency in the land acquisition, rehabilitation and resettlement act 2013. There is one section in that act 96 for which TDR is come on that act, then it will be exempt from taxation. But there was no provision in the income tax act. Even though it was mentioned, the issues have been raised, whether it is qualified on that act or not. And therefore, now there is a provision in the income tax itself. If you get a compensation, monetary or in the form of TDR, then that will be exempt under Income Tax Act. And therefore, Schedule 3 is been provided in 2025 Act. Is also applicable from 1st April 20. There is one more provision which I would like to make out is block assessment. There has always been an issue for the block assessment in the search provisions. And there was an issue, which is the block period. So now they define what is last authorization, which we need to take into account. And that last authorization will be now the block period. There will not be any issue. The year of search, 6 years from that will be the block period to work. There also this provision is applicable for the search conducted after 1st April 2026. So all search provisions which are there in 31st March, provisions search which have been conducted right now or which are been happening, also they are governed by the old act only. There is no such provisions to work out. Those all dichotomies we need to face. Simultaneously, there is always been a dichotomy for the, if there has been a search. Yesterday only in our office meeting, one of my partner has given example. कि other partners के search पे हो गया and there is a noting found which is written by me in his mobile. So what will be there? Today's provision, because if he was discussing yesterday, so yesterday's provision is this. This provision of what it says, even if 1 year notice is found, all 6 years has to be reopened. And once it is reopened, we know what happened. This is the only section, assessment, which is not faceless. So you are knowing what is the fate of such assessment. To remove this dichotomy, if in case of a person in whose case search is not happen, and there some incriminating material is found with a person in whose case search happened. In that case, the implementing material is read only 1 year, then year of search and that year are only a block period for this person. Not all the assessment years need to open. So that has been one more thing which been noticed in this. One more section which has been a very liking one for the us also and for the department also, and that is 115 BBE. We know 115 BBE, this provision was been brought in 1961 Act when demonetization came. Demonetization came back, what they say is, prior to that, what used to happen, anything addition is made under section unexplained cash credit, unexplained things, unexplained bank loan, all everything, it will be routine tax used to make out. They later on found out it's a section 68, bunch of sections to it. 68, 1, 2, B, C, D, E, all. Those have been substituted with now say 101, 102, 103 in the new act too. So 102 to 106 probably new act. All those provisions says those have been deeming fiction. If you are not able to, it's undisclosed income, undisclosed asset, unexplained expenditure, and tax rate was brought in the demonetization itself 60%. When tax rate was about 60%, they also levied surcharge of 25%. 4% education cess. So it was coming down to somewhere 78, 79%, and plus 10% penalty. So that much tax liability was been there. Now in such cases, now there is a provision of only 60% the tax rate. So people were complaining this. So they said, okay, we will reduce it to 30%. But they reduce it to 30%, welcome you. But they have not changed the provision of surcharge. Surcharge is still 25%. Education is still 4%. And now they have brought this provision in 270 and a penalty under the misreporting. So 200% penalty. So if you happens to be in any one of this section as item, you file the return, you so moto disclosed it, you are saddled with 30% plus 25% surcharge plus education charge and interest, etc. But if assessing officer discovered it, then it's a 30% plus surcharge plus education cess and 200% penalty. Now, if you wanted to go for immunity, you have to pay 120% of the tax. So provisions, one side is welcome, but other side, some part is remain. Probably when we represent something, it will be jot down. Otherwise, these provisions have been very, very, very lacunar. But issue comes to my mind also. Now, if this provision come, there are many cases which we find in demonetization, cash has been deposited. We find there has been one credit society where we found there are many amount have been deposited and additions have been made under section 115 BBE. Whether those pending cases, live cases, can we take this shelter, saying that when if the intention to reduce this is this 30% is applicable to them also. It's a fate. We'll see what happen going to work. Then comes to a provision of buyback of share. At present, buyback of share, which deals with is what? It is treated as dividend. And there is no deduction of cost of acquisition. So dividend is taxable. Cost of asset which you acquired the share, you are allowed to be capital loss. So this was going on. Now, the amendment, what is proposed is, proposal is that there are two classes they make out. They said there are promoters who are been influencing people, and there are promoters which are companies also. They are also influencing. For them, something different. But now they say there is no dividend. Buyback of share, capital asset, you are liable to pay capital gain tax. On what? Your sale consideration, that buyback consideration, minus cost of acquisition, maybe indexation available, you take it, not take it. It's a beneficial which you work out in that and pay tax. But in case of the tented people, I can say, or the influenced people, if the promoter is individual, they will have to pay tax 30%. Like capital gain here is okay. but differential amount will be, they will have to pay out of their pocket. So they are liable to pay 30%. And if the promoter is company, they are liable to pay 22%. 12.5% is a capital gain, and difference between that is 9% 5. That promoter has to make the payment. This provision initially was found to be favorable to the SSC. Why? Because what people used to do, they have a business loss, income from dividend. Current year's loss is set off against that. They hardly has to make the payment of tax. Or last year's we have been very big relief of 12.5 lakhs rupees, no tax. Though I have reservation, it's not the case of 12.5 rupees. Because even if you have 4 lakhs rupees income and 2 lakhs rupees short-term capital gain, you need to pay tax on short-term capital gain. So that 12.5 is a myth. It cannot be said on that line. So there in that situation, dividend was been taxable and dividend was been beneficial. But now there is no choice. You have to pay capital gain tax only. And for the people like you and me, it is beneficial because we have to pay 12.5%, nothing more than that. That takes me to another provision of STT, sea change. We have seen the impact and we have seen reverse impact both ways. I need to talk on that because share market, probably my co-speaker Dilip ji will be continuing on that. Dividend and interest, there is a rationalization now. What was earlier, if you have borrowed the funds, if you have invested in shares, if you receive the dividend, then you are allowed to claim that interest, but there was a 20% only of that gross dividend is allowable deduction. For example, 1 lakh is a dividend income, 25,000 rupees is a borrowing cost. So what you used to get deduction is 20,000 rupees. But now amendment proposes against dividend income, no expenditure is allowed. It is fully taxable. But what happened if I have considered the shares as a stock in trade? If my shares are stock in trade, then I'm a businessman. I'm a trader. Entire interest cost, I borrowed the funds, is allowable deduction. Other cost also allowable deductions to work. There is one provision, cryptocurrency, which we all talked about. We are not knowing. But now, if you are not giving intimation about the cryptocurrency, if you are not filing the statement which is required, we will have a penalty of 200 rupees per day. And if we furnish inaccurate particulars, inaccurate information, due diligence requirements not complied with, then there is a fixed penalty of 50,000 rupees we need to make out. So cryptocurrency, always check up with the client. Some people in a process of just going to accumulation by 5 or 6 coin, also Bitcoin, it also amounts to the same way. And if that information not there, 200 rupees penalty per day, calculate or copy with that. For charitable trust. Charitable trust also, there are 2-3 welcome provisions. We know that if a trust we do not file the return in time, then probably there will be a cancellation of registration under 12A. If there is a cancellation of registration under 12A, then there is separate provision which they made out. Accumulated assets and liabilities, all 115 TD was with there. Same are continuing in the next act also. We have to face up loss of, and that working of the tax amount will be beyond on that trust. So they said now, here, even if there is a belated return, you can file it. So if belated is filed, you have to pay that penalty or fine, but it is possible to work. Again, there is one more good provision is that there is a specified violation which has been prescribed. The specified violation contains a lot of information which need to be provided, maybe making payment to trustees or making payment to some HUF, some other expenses. If those violations are there, then your section 12A registration also be in danger. There they have given specific what that violation should be. They have specified it to us. One more clause which I wanted to draw your attention is, that is section 400 subsection 2, which speaks about, they have amended under that section. I will read out that also provision. It's been very, up till now, all of where we were under assumption that CBDT instructions or notifications are binding only on the authorities. It says section 400 subsection 2 has a power that board with the previous approval of the central government may issue guidelines to remove any difficulties arising in giving effect to the provisions of TDS/TCS chapter, and such guidelines shall be laid before each house of the parliament. Corresponding provision in the Income Tax Act, now they are provided that such guidelines shall be binding on the income tax authorities and on the person liable to deduct or collect income tax. However, section 400 subsection 2 of the Act does not contain aforesaid clause which binds the guideline. Now, this clause they proposes, with this proposition, if today it comes for the TDS and TCS, there is likely to come for the other things also, which will binding on the authority. So there is a goodbye to the proposition that CBDT circulars or CBDT instructions are only binding on the officers. Now it is binding on the taxpayer also. Then last two things which I will speak on, the DIN and that retrospective amendment issue, which Akshay ji referred in the opening remark. There are a lot of retrospective amendment. And yes, a lot of hue and cry is made on the retrospective amendment. For that, I need to give a background also. It was started with the reassessment notices. Who is the jurisdiction officer? Whether it's a judicial assessing officer or a faceless assessing officer. And in the COVID period, under the TOLA, section 151A has been introduced, which enables the central government to notify a scheme of reassessment under 147. In those scheme of reassessment, we find that reassessment that FAO has no authority, JO has no authority to issue notice under section 148. If it is governed by that scheme, that FAO only has to issue. And there are a lot of appeals which have come across. When a landmark judgment is of Hexaware of the Bombay High Court, which is pending before the Supreme Court. Just in the afternoon, my brother updated me, Supreme Court has again diverted to the respective high courts to decide on this because they have brought a retrospective amendment. The retrospective amendment, which of them? One is that new section of 147A, which is brought retrospective reassessment from 1st April 21. So right from inception. This says JO and FAO have a concurrent jurisdiction. Then they have introduced section 292BA. For what? Validation of DIN. We all remember when the DIN has been started in the House of the Parliament itself, there was an announcement by Honorable Finance Minister stating that if you received any notice without the DIN, usko kude mein fek do. And now where it's gone. Friends, I just wanted to recollect you, even 2014, when Arun Jaitley ji was the finance minister, on the floor of the House in the case of Videocon, when it is reviewed, they categorically made, we will not do any retrospective amendment. And what they have done with these two things to work. And there are two further provisions which have been brought on that is the DIN also. Then there is also been transfer pricing amendments clarify the application in time limits that also come with it from the April 2009, October 2009. Then TP order limitation also come from 1st June 2007. And what is the justification they have given? Justification they have given to settle continuous issues. The government argues that it was never the intention to mandate National Faceless Assessment Center to perform pre-assessment inquiries. But when you frame the policies, when you frame the scheme, why you are making this? Then to reduce litigation, divergent views from the various high courts led to chaos. These amendments aim to provide certainty by reversing judicial precedent that favored taxpayer and protect revenue. The amendments are designed to prevent tax evasion through a procedural loopholes. So what is our argument can be is violation of confidence. Any amendment that reverses favorable court ruling is giving a fresh liability for the taxpayer by receiving a dead case, thus violating the 2014 pledge which was taken in the Parliament of Parliament by Arun Jaitley ji. It was the finance minister. Then uncertainty, respect to changes, diminish the trust in the taxation system. It have deterrent on foreign investment also. It's going to work. Then procedural versus substantive. While procedural changes like DIN can be tolerated, but retrospective validation of jurisdiction section 147 is viewed as substantive changes to implement the rights to work. Friend, when I said when the faceless scheme frame under 151A, which mandate that notices under section 148 must be issued through automated allocation in a faceless manner. The scheme clearly investigates issuance of reassessment notices by a national faceless assessment center and not by the judicial officer. So there was no enabling power under either 151A or the scheme to permit JO to assume jurisdiction for the issuing reassessment. And therefore, there will be a lot of, again, litigation which is going to come. And we are saying one side, it's been we wanted to have simplification, we wanted to have reduction, but this is not going to come. There will be a lot of, again, because all the orders, if you find, now Supreme Court has passed on to them the High Court. So High Court has to again verify whether constitutionally can a department make retrospective amendment. And there has been very old judgment in the context of, I believe it was by somewhere 80JJ or 80M. It's a distillery, Baroda Distillery's case. It was Supreme Court, there was a lot of discussion was made whether such retrospective amendment is possible. So there will be a lot of hue and cry again with this. So all those retrospective amendment which will be probably we'll have to see, we'll have to wait, because all Bombay High Court orders, what they have passed by setting aside the assessment order is they have set aside with a liberty to the department if Supreme Court decide against that. So by retrospective, they will not able to have issuance of fresh notice again. Friends, allow me to conclude with the solemn reflection. I know I have exceeded 5 minutes with the time which has been provided to me. But I reminded of an anecdote. Though it goes to the Indira Ji's regime, when entire family was available, Indira Ji's, Sanjay was there, Rajiv was been there, and our laws, fiscal laws, income tax was been there itself. So she was been worried about all those. So she prayed to the God. Goddess came. You're happy. You ask your wish. So she asked whether my son Sanjeev will become Prime Minister of this country. God replies, not in his lifetime. Then she asked whether Raju will become Prime Minister of this country. He said, not in your lifetime. So she fed up. She said, now third question, whether there can be a good fiscal laws, finance minister, which can have our fiscal laws correctly, income tax act, those two. God says it is not in my territory also. So in my life also it is not going to become. And we pick up the same thing to her. So, friends, when law matured, they stop threatening and start guiding. Budget 26 somewhere reflect the growth and the vision of our prime ministers ki global pehchan badhani hai. But what about to the people on this earth? It does not attempt, this 2026 budget on direct tax fund does not attempt to please us, does not have dramatic changes, but some debate retrospective clarification, some relief expectation remain unfulfilled. But from the systematic standpoint, the message is clear. the focus has shifted from extracting compliance to the enabling compliance. So there is shift from penalties to the fees. There is a shift from focusing on discipline. There is shift from changing entire scenario from looking up to the fact. But simultaneously, I can say provisions which came across are not as simple as they has to work. For us as a tax professional, this budget also redefines our role, because you must have noticed somewhere accountant myth concept has been developed for MSMEs. So for giving guidance, they are asking our institute to ICI, ICWA, CS all, and I must place on the record, our MTPA is also doing that job of having one course every time where all those mitras are being created, who are being having above the knowledge of the people who supports all genuine to one. So having observed and discussed the budget's proposals to my mind, which are required from this very platform over 10 years, I can say with conviction, budget 2026 may not be loud, but it is lasting. We have to face its success will lie not in announcement, but in implementation, consistency, and administrative discipline. In the spirit of this budget is a carry forward on the ground. It has potential to significantly reduce avoidable litigation, but with a rider of retrospective amendments to it. I once again express my heartfelt gratitude for AIFTPA people, my MTPA, all office bearer, my friend sitting here, my partner sitting here, and I will be feeling in my duty for making gratitude to my entire SPCM team who have worked like day and night for preparing such notings for me where I'm able to deliver this lecture. I must say that after all, friends, tax laws may change, but the trust reposed on our profession must never change. Thank you very much.
Thank you, sir. Now all our tax professionals will come to know how many changes were done in the budget 2026 and why we are conducting the decoding of the budget by our experts. Now we will conclude the first technical session and immediately we are moving to the second technical session. For the second technical session, the faculty for the second technical session, CA Dr. Dilip Sabbai sir. And for introducing the faculty, I invite our committee member Kailas Kashit sir to introduce faculty Dilip Sabbai sir. Sir, please.
Good afternoon. Dignitaries on the dais, online participants, seniors, past presidents. I am Mr. Kailas Kashit, Joint Secretary of MTPA. Stand here to introduce today's speaker for other major changes in budget 2026. CA Dr. Dilip Sabbai sir. Sir is a renowned chartered accountant, academician, and thought leader, widely respected for his deep expertise in direct and indirect taxation, auditing, financial planning, and investment consultation. Sir is the senior partner of Messrs. D.V. Sabbai and Company Chartered Accountants, Pune, a firm with a long-standing reputation for professional excellence and ethical practice. Sir is a chartered accountant, PhD in law, master's degree in law, ranked first University of Pune, merit holder in CA Intermediate and final examination. Holder of multiple
डिसेबल केलाय तर म्हणतात
including international taxation, GST, forex, and treasury management, forensic audit, risk management,
You cannot start your video because it is disabled.
and more. ज्ञान वही सार्थक है जो समाज और पैसे के हित में उपयोगी हो। Sir is the former chairman, vice chairman, secretary and treasurer of Pune branch of WIRC of ICAI, former member of International Standards ICAI, New Delhi. Faculty of ICAI for GST lectures at all India level. Convener Pune GST Study Group, Chairman Direct Tax Committee, Maratha Chamber of Commerce, Industries and Agriculture, Chairman of Maharashtra State CA ABPM Group, connecting professional across infrastructure. Clarity in law begins with clarity in thought, and that's what he brings to the every lecture. Sir is also of ICI handbook on drafting of bill nomination in intricacies, he contributor to practical FAQ under GST and investor awareness program. Regular columnist in leading local newspaper, author hundreds of articles on tax laws, economics, investments, and corporate governance. Sir is National Merit Scholarship holder, recipient of Ramdan Prize of Nehru Memorial Special Prize, honored with special mementos by Sri Sharad Pawar and the Mayor of Pune.
प्रसाद NTK और प्रसाद देशपांडे
Regarded as sound investment consultant in Maharashtra. Sir is the Honorable Treasurer, International Reference Union and CASP NGO, founder and lifetime chairman of Usha Lal Charitable Trust and PT Lele Pratishtha. Trustee and director of several charitable trusts and 8 companies. In today's session, our other major changes in the Union Budget 2026 document. There is expertise, insights on key amendments in the Income Tax Act, focusing on practical implications, compliance challenges, and professional strategies. We are privileged to have with us a professional who truly represents the idea combination of knowledge, experience, integrity, and service to the profession. It is indeed an honor to welcome CA Dr. Dilip Sadhbhai sir for this budget 2026 special session. With this short introduction, I request you all to please welcome in big round of applause. Thank you.
Thank you, Kachin sir. Now, I request our committee member, Mr. Subhash Godke sir, to felicitate CA Dr. Dilip Sadhbhai sir. Sir is available there in the office of Sadhbhai sir. I request Godke sir to please felicitate. Thank you, sir. Now, I request Dr. Dilip Sadhbhai sir to please start your session. Floor is yours. Thank you, sir. Unmute yourself and continue, sir.
No, I have to share the PPT.
Yes, yes, sir.
तू येते का PMC PPT कशी शेअर करायची बंद करतो कुठली करायची ते तुला दाखवतो हे बघ ओपन होत आहे हा ओपन सेव्ह कंटेंट ही करायची.
Sir, please remove
Now
your
it's on.
mic because
Just
you-
half a minute. Ankit is doing sharing.
Okay, sir. Okay, thanks.
पंधरा डेट बघायचे कुठे कुठे दिसत नाही ना. वन ड्राईव्ह नाही येते डेस्कटॉपवर. साक्षी शेअर कसं करायचं कळतं का तुला? शेअर अलीकडे करायचं. इथं नाही, शेअर इथं आहे, डेस्कटॉपवर आहे. काय झालं?
शेअर झालं
आणि शेअर कुठे झाली पण ती?
ठीक आहे, तर शेअरिंग चाललंय सर. तुमची स्क्रीन शेअर झाली तिथे.
The screen is visible.
हा
झाली शेअर आली का बघा, विचारून घ्या ना. माझा फोटो दिसत नाही पण इथं काही मुली.
सर.
Screen is visible, sir.
वेदर आय एम विजिबल,
Yes, yes.
माय फोटो इज ऑल्सो विजिबल. Camera is on.
Just click on full screen, sir. Or press F5. It will automatically get full screen.
F5.
Right side.
Right side. Speaker said, where is camera?
Okay, now it's visible. Yes, continue.
कॅमेरा येतोय नाही, इथं दिसत नाही मला. Good evening, friends. It gives me immense pleasure to be here from my office and thank the management of the Maharashtra Tax Practitioners Association for giving me an opportunity to address all of you on three important topics where the amendments have been made in the latest budget 2026. But before I go into the details, let me thank the office bearers of the Maharashtra Tax Practitioners Association in general and Anirudra, the chairman of the MTP Association. Then Subhash Godke, who is over here to present a memento to me, along with Ankit Kadam. And one more person that needs to be mentioned, who is the called to be as Sri Krishna of Maharashtra Tax Practitioners Association, wherein you will find that he is nowhere, but everywhere he is present over there, nothing more than Narendra Sonawane. So other people are also there, other persons are also there. And I'm thankful and grateful to all of them for giving me an opportunity again to address all of you. Though it is late because I was supposed to deliver a lecture at 4:30 p.m. in itself, but now it is already 5:25. I have one more lecture after this particular things are concerned, but the topic is not much. Only 6 amendments are required to be covered up so far as the GST law is concerned. Then we need to see some of the changes which have been made in the PROI, that is pertaining to the Foreign Exchange Management Act. Then we have also to see some of the provisions of railway corridor, which is affecting Pune in general. And last but not the least, the MSME benefits, which ultimately can give some sort of a incentive to that entire MSME sector in itself. So keeping that particular point in mind and the limitation of time that is available for my disposal, I will try to cover up and give justice to all the topic in the next 30 minutes of time. So let us start with the first GST law, which ultimately talks about 6 important amendments which have been made in the section. First, we will see 15(3)(b), which is pertaining to the post-sale discount. Post-sale discount is a very important topic under GST, and we need to concentrate on that just to understand what ultimately change has been made in this particular direction. You could be aware that very in a brief manner, our finance minister enunciated or enumerated all the 6 changes which have been made in the GST law. But shorter the time she has taken, more the longer duration and the time and impact that it will be having to the GST people as well as those who are going to affect by that particular amendments. So even though the amendment looked to be small and meager in number, the cascading effect of these particular amendments are vast in number and vast in approach, as a result of which everyone will have to learn about this, otherwise they are going to suffer and their clients are also likely to suffer should these particular amendments are not known to them. The Union Budget 2026 has already amended now Section 15(3)(b) of the CGST Act in order to simplify post-sale treatment by removing the prior agreement requirement. So what was the requirement prior to this particular amendment that we will see in a minute's time? But what change has been made is that it has been simplified, that whatever CG Act was talking about, it has simplified post-sale discount treatment. So the topic is pertaining to the post-sale discount treatment, and that is the major area which we need to understand. Previously, such discounts could only reduce the taxable value if linked to the specific invoice via agreement, which means that it was being allowed only to reduce the taxable value provided agreement was being there. But now they qualify solely if the credit note is issued under Section 34 and the recipient reverses proportionate ITC. So let us see what are the key changes in this particular point number 1. Now, the first important point which is required to be remembered in amendment number 1, that unless there is a prior agreement, the deduction about the discount was not being allowed under the earlier agreement, under the earlier provision. Now, discounts are given after supply and they no longer require pre-supply documents or invoice linkage. So initially, the discount to be offered at the end of the year or during the year was linked with invoice, which means that unless and until you have sold out something and invoice is being there or some sort of a tax invoice is there, the discount was not being allowed. But nowadays, this has been de-linked from the invoice in itself. Documentation is again not being required. Agreement is also not being required. And that is the mandatory requirement that they have changed from this particular year onwards. Second important change that has been made is nowadays, in order to get that discount being effected in the invoice in itself, credit note has been made mandatory, which was not the case in the earlier times. Only the requisition was being required, and now credit note serial number has to be there, and that is what the condition that has been jotted down in amended section 34(1), which specifically talks about this particular matter. The third important point, which was being just mentioned over here, is the reversal of ITC by both parties. So in that particular case, recipient has to reverse the ITC, and the other also is required to ensure that revenue neutrality is being maintained. And this particular date for notification will be from 1st April 2026. In order to understand this particular provision, 3 aspects we have covered over there. no agreement is being required. That was point number one, which we saw. Then credit note has been made mandatory. That is the second point that what we have seen. And the ITC reversal by both the parties is being required. So let us see a practical example in order to understand this particular intricacy. A supplier has sold out certain goods for rupees 1 lakh, GST at 18%, that is 18,000, to a buyer in June 2025. So in short, in June 2025, the seller has sold out goods worth rupees 1,18,000. The main price will be 1 lakh of rupees, GST component 18,000 rupees. In March 2026, the time to come, for achieving manual targets in order to give some incentive to this particular dealer, the supplier has offered rupees 10,000 as post-sale discount without prior agreement. So again, this is the major issue, that 10,000 rupees has been given not for that what sale has been effected in the past, but it is being given for some sort of an incentive, which is likely to be a, you may call it as a gear running up, ultimately to gear up the activity in future. This particular 10,000 rupees discount is a post-sale discount. It is not pre-sale discount, it's a post-sale discount, and that is the main issue which has been addressed over here in this new amendment. Now, prior to amendment, what would happen? Discount was ineligible for exclusion without prior contract linking to the invoice. Full GST was payable on 1 lakh of rupees. So even though the price that was received under the old agreement was only 90,000 because 10,000 rupees is given by way of a discount, in that particular case, the contract price was being considered as 1 lakh of rupees is the major issue. Then the post amendment, according to new law now, supplier has issued credit note for rupees 10,000. Proportionate GST was rupees 1,800. Taxable value reduces to 90,000. GST component 16,200. Supplier has to reduce output tax by 1,800, and buyer also has to reverse 1,800 rupees. So in short, the reversal of the input tax credit to the extent of rupees 10,000, because 10,000 is the discount in itself, reversal of ITC to the extent of 10,000 rupees will be carried out to the extent of 1,800 at 9% for supplier and 900 rupees for the buyer in itself. So both will have to do 900 rupees each for reversal of ITC, and once that reversal of IT has been carried out, then and then only the neutrality will be there. So this is what the first amendment that has been made. I repeat again this particular amendment once again. There are three ingredients which are required to be remembered. Prior to amendment, agreement was mandatory. Now, no prior agreement is required. Credit note under the new amendment is mandatory. And third important point, ITC reversal by recipient is also mandatory to understand the situation. So this is what the general feature of the amendment is being there. So you may raise a query, what are the impacts of this particular amendment on the entire business scenario? This amendment will reduce litigation on discount validity, because now and then there are so many litigations which are going on this particular matter, whether discount ITC should be reversed otherwise and so on. It eases out the compliance as well for distributors and retailers using volume of performance incentives, and aligns GST with the commercial practices while safeguarding revenue via ITC reversal is concerned. So all the ingredients of protection and protectionism have been upheld, and accordingly those have been incorporated. This will create a good ease of doing business for all the persons involved in this particular category. Coming to the second amendment, which is one of the six amendments which we have to cover, and that is specified in section 34 of the CGST Act, and it will include even reference to section 15 of the said Act. Now, cross-referencing is also there. Section 34 is being updated again to explicitly include references to section 15 as well. Now, what is this amendment all about that we need to look into? What is section 34 that we will see in a brief manner? 34(1), where one or more tax invoices have been issued for supply of any goods or services or both, and both the taxable value and tax charge in that tax invoice is found to exceed the taxable value or tax payable in respect of such supply, or where goods supplied are returned by the recipient. So this is what the credit note that what we have been talking about. Where goods or services or both supplied are found to be deficient, the registered person who has supplied such goods or services or both may issue to the recipient one or more credit notes for supplies made in a financial year containing such particulars as may be prescribed. So this was pertaining to the clarity that was being required with reference to section 15 of the CGST Act. And that is how what the change has been made, that also we will see and look into the matter. So let us see, only one sentence has been modified, but I will have to read the entire section again. Where one or more tax invoices have been issued. So I am the person who has issued 2-3 invoices for supply of any goods or services or both, and the taxable value or tax charge in that tax invoice is found to exceed the taxable value, which means that the tax which has been deducted is more, and where the goods are supplied or returned. When the goods are returned, there is no sale in the technical sense, or where the goods or services are supplied are found to be deficient. Whatever has been given, that is not as per the expectation. Now, this is the new line that has been added over here, or where the discount referred to in the respective section of section 15 is given. The registered person who has supplied such goods or services or both may issue to the recipient one or more credit notes for supplies made in the financial year containing such particular. As a result of which, what is going to happen, that is more important in this particular matter. So what is the importance? That earlier times, when the goods were sold, returned, etc., whether GST was reversed or not, whether it ITC was reversed or not, that was not being done because there was no credit note in the technical sense. But now this section 34 read with section 15 now makes mandatory requirement. It is as good as post supply discount. It is as good as post supply discount, and accordingly the treatment is required to be made. As a result of which, whatever GST that you have paid earlier, now that can be claimed as amount that will be reduced from the amount of discount that you will be giving. Reversal also will have to be carried out in that particular sense. So this amendment provided more legal certainty with respect to issue of credit notes for post-supply discount in itself. So the first two amendments that what we have seen so far are applicable only to post-sale discount in itself. So this is the first and the second amendment that we need to make it out. But I caution you, all of you here, that this amendment is to be made only from the date of notification and not from 1st of April 2026. The government will make a notification in the Gazette saying that this particular amendment will take into effect from such and such date in future. As of today, the date has not been notified. It's simply a provision which is incorporated in the law, but it doesn't have any biting effect so far as the technicalities are concerned. Coming to the third point, that is pertaining to the provisional refunds under section 54 of the CGST Act. Budget 2026 has amended section 54(6) of the CGST Act to extend 90% provisional refunds to unutilized ITC from inverted duty structures under section 54(3) Roman small 2. Now, I invite your attention on very important issue, that there is a VIP treatment that is given to exports. As a result of which exports are being there, they need money, everything. So refunds are being given to them. But that is not the case of ordinary people like those who are suppliers, buyers in India in itself. They are not exporting the goods. So as a result of which, prior to this amendment, the discounting and refunds, etc., was restricted only to the zero rated supplies like export which now covers where input tax rate exceeds output rate taxes. So the input tax credit is more with you than the outward tax that what you are supposed to pay. Now you are eligible as like equal to that of export to claim that particular refund, which is the most welcome decision and amendment that has been made in the GST law so far. So this I give 100% credit to the finance minister for making this particular thing happen in GST, which otherwise we were thinking that refunds are very, very, very complicated and they are not likely to be received sooner or later. And as a result of which, every time we have to tell our clients that wait for some time, and how much sometime, that time was not being there. So this is what the situation was there. But in the recent times, I have learned that the refunds from 3 to 6 months only delays are there. But ultimately, this may happen from case to case and from person to person as well. Now, what are the key changes in this refund? Provisional refund, add phrase or of the unutilized input credit. First proviso section 354(6), enabling 90% upfront sanction. So if, for example, now you are having a input tax credit to the extent of 10 lakhs, then you have got an output liability to the extent of 9 lakhs. So 1 lakh is the extra input tax credit that what you are having. So this 1 lakh input credit, if it is more, 90% of that, that is 90,000 rupees, you can claim upfront is the change that has been made in this particular category in itself. So remaining 10%, which I just been talking about, is subject to verification and audit. Full process remains unchanged so far as the things are concerned. This particular change will be effective post notification by central government, which is likely to be issued on 1st of April 2026. For example, a textile manufacturer buys yarns at 18% GST, inputs 1,20,000, ITC, how much is the amount that is going up over there? Whatever is the ITC on 1,20,000, at 5% GST, output is 1 lakh and GST is 5,000 rupees, which means that 1,20,000 is the input that what we are getting, and the sale that what we are affecting is 1 lakh on 5% GST. So we are paying 18% and 5% what we are getting over there. So there is a clear-cut monthly unutilized ITC of 16,600 rupees. So it's a simple case that I am buying on 18%, selling that at 5% GST output on 1 lakh of rupees. 1,20,000 is my purchase. So what was the result in the pre-amendment cases? Full claim process after 3 or 6 months of time delay, not 3 6 months of delay. So as a result of which, practically whether you are getting or not, then other things are required to be also considered. Now post amendment, 14,940, that is 90% of 16,600 rupees will be sanctioned provisionally within weeks. Within weeks, balance will be transferred after scrutiny. Improves cash flow by 1,80,000 lakh annually for similar operation, because this will be the amount 16,600, 90% will be 14,940, multiplied by 12, it works out to around 1,80,000 rupees. So 1,80,000 will be your cash, you may call it as a cash flow that will come to you, which otherwise would require longer time so far as the matter is concerned. So this is again a very welcome decision that has been made by the finance minister, for which she needs to be complimented. So this is what the major issue is being there. Now, what are the impacts on business? That it will address the liquidity, that what I already told you, because textiles nowadays are facing lot many problems because of the Trump tariff in itself. They are not in a position to export. They are not in a position to do anything inside the country in itself. And they were requiring some benefit and some sort of a incentive from the government in itself, because you might be knowing that the textile in USA, the export that we were giving it to the US were having a tariff of 2.53%. And once the crude oil was being imported from Russia, and additional tariff was being added, 50% was added in that. So 52.53% was the tariff, and that ultimately made our export practically incompetitive even with the Bangladesh or Indonesia or Vietnam, which are our competitor, because they were selling much lesser than 30% of the value that what we were offering to them. So as a result of which, this particular cash flow was being required for textile industry in itself, and for others also. But textile industry, they were having an export of around 4,800 crore dollars, and that is the reason why perhaps this may be the reason as to why this particular amendment has been made by the finance minister in itself. Now, chemical steels also fall in this particular category, wherein RTC accumulate due to rate inversion, cutting working capital blockage, and interest costs. It reduces litigation on delays, pairs with export refund threshold limit for broader relief. Exporters and IDC claimants gain faster funds without added revenue risk to the government in itself. So this is what the impact that this particular change will be having. Coming to the fourth point, to provide a refund below rupees 1,000. This is again connected with that, but is a section 54, which we need to look into. Subsection 14 of section 54 of the CGST Act is being amended to remove the threshold limit for sanction of refund claims in case of goods exported out of India with payment of tax. The Finance Bill 2026, subsection 8, section 13 of the IGST Act, making intermediary services follow the default place of supply rule under section 13(2), recipient's location. This ends the prior domestic taxation of exports, enabling zero rating and refunds for Indian service providers. So keeping this particular point in mind, this has been mixed together in itself. Point number 4 was pertaining to the refunds. Nowadays, it has been made mandatory that whenever refunds are being carried out, those refunds below 1,000 rupees also will be given priority in itself. Coming to the fifth important point of the amendment in itself, that amendment says that place of supply for intermediary services in itself, section 13 of the CGST Act in itself. Now, this omission of clause is very important, and default provision application is also comparatively important. Due to this omission, which has been carried out in the subsection 8 of section 13, that the place of supply for intermediary services now will be determined according to the default provision of section 13(2). This is a major amendment that has been made in the GST law, because initially when the law was being there were two options were being there, and under that particular, at the recipient's place or at the place of supplier, these two clauses normally are there, but section 13(2) itself has been dropped out, as a result of which major change has been made, and as a result of which now the shifting of place from place of supply, it has gone to place of recipient in itself, because the word place of supply has been removed from section 13(2), and once that the amount of once that particular clause has been removed, in that particular case the recipient location will become the default location so far as the things are concerned. This resolves the long outstanding issue where intermediary exports were taxed as domestic supplies, denying zero rating and refunds. What was happening? Let us see. Under section 13(8)(b), place of supply for intermediary services, that is agents facilitating deals between third parties. So we were exporting the goods, but we were exporting the goods through intermediaries. So these persons were located at Mumbai, Bombay, or Kolkata, any other place, and they were having contact with the exporter, the person who were importing from India in itself. So in that particular case, the place point of supply was considered to be place of supplier's location. So I am in India, I am supplying goods to intermediary. So place of supply was the governing point so far as the thing was being concerned. For Indian suppliers serving foreign clients, point of supply remained in India, treated as interstate supply. For example, third parties in Kolkata, I am in Mumbai or Pune, supplying goods to intermediary in Kolkata. So this will be an interstate transaction in itself. IGST was applicable as per the place, but not the zero rated tax, which ultimately intermediaries were supplying those particular goods to third country in itself. That ultimately was the triggering point that we need to make it out. So this point of supply remained India in all the cases, treating this entire supply as interstate, liable to IGST, but not zero rated like export. So blocking refunds process despite foreign exchange earning, imports escaped RCM as was POS was abroad. So this is the repercussions existing law that I'm just making out. Again, to sum up in a manner, intermediary was located in different state. The manufacturer was located in different state. When the goods were sold to intermediary, who in turn was exporting those particular goods to a person outside India, the benefit was not occurring to the supplier. The supplier was treating this particular transaction as interstate transaction and not export in itself. So the benefit of exports not were being given to this supplier in itself. Now, under the new change that has been made now, Section 13(8)(b) applies to Section 13(2). So point of supply will be recipient's location and foreigner's location, which will qualify zero rated burden in itself if conditions under Section 26 IGST Act are made. That is, amount must come in foreign exchange if forex payment has been made, and import figure RCM if recipient is an Indian. Effective date aligns with other 2026 GST changes. So point to be remembered here that the sale of goods, supply of goods which were being effected from manufacturer to the intermediary was treated as interstate supply. Now under the new amendment now, the goods will be presumed to have been supplied to the concerned person in third country in itself, as a result of which the recipient's place will be considered as the place where the goods are supplied through agency, and as a result of which it will be considered as zero rated tax, and accordingly all the benefits will now will be available even if the goods are being sold out to the intermediary, is the brief point that what you need to understand. Now there is a table which I have prepared over here, that point of sale, the place of supply in case of determination under the earlier law was supplier's location. Now under the amendment now, it has gone to the recipient's location. Then export status in India, abroad, it was initially was being considered as domestic. IGST was payable, no refund was allowed. Now under the new amendment, it is considered as zero rated export. LUT refund is also eligible. Import status abroad in India, no GST POS abroad was being considered. Now RCM on recipient will be mandatory. Litigation risk high under the old regime and now low in the clear regime, because clear export treatment is being accorded to this particular sale through intermediary is being concerned. Let us see some practical examples. Pune IT firm acts as an intermediary for US client sourcing software from global vendors, 1 crore fee in US dollars. So 1 crore fee in US dollar was to get. Pune IT firm was acting as an intermediary for a US client sourcing software from global vendors. Pre-amendment situation. Place of supply is India, 18% charge. IGST at 18 lakhs, outflow, no refund. Now under the post amendment, the place of supply will be US. It will be zero rated tax, full ITC refund, and LUT supplier saves cash. So this is more important, because if the amount is 1 crore, you are going to save entire 18 lakhs of rupees in this particular situation. Now, in case of import, Mumbai exporter hires Singapore agent for overseas procurement 20 lakh fees. Pre-amendment, place of supply was Singapore. No GST was applicable. Now, under the post-amendment now, place of supply will be India. RCM GST 3.6 lakhs is payable, but ITC is claimable if inputs are being there. So this is what the major change that has been carried out so far as the practical examples are being concerned. Now, the impact on the benefits or dealers are required to be noted down. Dealers exporting intermediary services like commission agents, etc., gain zero rating, unlocking no refunds, potentially in thousands of crores of rupees industry-wise, and boosting competitiveness without 18% GST burden. There is no need now to pay 18% because it is zero rated export in itself. Reduced litigation ends decade-long court battle, because this was the ticklish issue where all the disputes were being going on, and as a result of it has solved out the entire decade-long court battle is being concerned. Imports face RCM, revenue gain for government but ITC neutral for compliant dealers. Overall enhances cash flow, simplifies compliances, and aligns GST with destination principle of service export. So that is the major benefit that we are likely to get so far as the situation is being concerned. The sixth and the last amendment in section 101A of the CGST Act is required to be covered. Now, 2017 CGST Act provides that central government may, pending the constitution of National Appellate Authority, they are still to form this, by notification empower an existing tribunal for hearing appeals under section 101B of the CGST Act to provide that the provisions of section 2 to 13 shall not be applicable where tribunal has been so empowered under subsection 1A. This change shall come into effect from 1st day of April 2026, because this is pertaining to the R, that is Authority for Advance Ruling, AAR. And in that particular context, this particular amendment has been made. Now, we will see that there are so many R's in our country that every normally state has one R, barring some few states in itself. And as a result of which, some different propositions, some different rulings have been given by these R's in itself. For example, in Maharashtra, they have said that on a particular product, the tax will be only 5%. Karnataka will say, no, it is not 5%, it will be 10%. The Calcutta High Court of the R will say, no, it is not 5%, it is 18%. So three R's have given three different treatments. So unless there is a national authority to decide that whether 5% is to be taken, 18% to be taken, or 12% is to be taken, it was becoming very, very difficult, and the advance ruling practically had no meaning so far as the technicalities were being concerned. And as a result of which, this created the entire raw material for making this particular amendment in itself. Now, this amendment has inserted new section 1A to section 101A with effect from 1st April 2026 to address delays in constituting National Appellate Authority for advance ruling. As like what we see high courts in every state, and we have got a Supreme Court in Delhi in itself. Similarly, for GST matter, ours particularly, there is one tribunal which is called as National Appellate Authority for Advance Ruling, that is just being getting accumulated and getting formed in itself. But so far, nothing has been done for that particular matter, because unless the NAA is being formed, there will be no meaning for these three different versions, because in India, we normally feel that if the decision has been given by High Court, it is binding on that particular state only. But if no such decisions are there in any part of the country in itself, then that particular decision will be binding on the entire country in itself. But if some state again gives some decision in itself, then in that particular state it will be applicable. Similar version is there for ours as well. So if our Maharashtra has given a particular decision, then in that case the or Maharashtra, it will be binding on Maharashtra government only, not on other states in itself. So this is the major issue that what we are expected to remember and understand in itself. So let us see what was the earlier position. Before this amendment, section 101A1 mandated the government to constitute NAA by notification for appeals under section 101B, which arise from conflicting advance rulings by two or more state appellate authorities for advance ruling. So if two different states are giving two different versions about implementation or any other matter, interpretation of law is being concerned, then in that case this was being required. As a result of it, now the change that has been made is that whatever existing structure of the GSTAT is being there, that will be considered as competent authority to decide such type of decision, which will be referred to them in itself. This is what the ultimate amendment that has been made in this particular matter. So it is GSTAT is the authority tribunal, existing tribunal, which will act as NAA, which will act as NAA pending its full constitution. So long as that NAA is not formulated, GSTAT will be acting as if they are NAA, and all this our decision will go to them, and whatever their decision is there, it will be considered as final decision so far as the technicalities are concerned. So this tribunal at present handles only section 101B appeals, conflicting or ruling, not routine GSTAT matters like ITC dispute, etc. So this is what the change that is required to be remembered. Let us see one example. Consider a manufacturer getting Maharashtra ruling that the present taxable rate is say 5%, while Karnataka High Court RR says it is 18% for the same product for identical facts. Pre-amendment, the aggrieved party files section 101B appeal to the non-existent NAA, leaving it pending indefinitely. Post April 2026, the government will notify GSTAT's principal bench under 101A1A. The appeal goes there directly, ensuring a uniform national ruling without waiting for NAA setup. So this is what the major issue that we will have to look into so far as the technicalities are concerned. There are certain advantages, but ultimately advantages are of little importance because ultimately you will be getting a decision, and that decision itself is very, very important so far as the things are concerned. Let us move to the next important point so far as the key comparison is concerned. Appellate forum dedicated to NNA not yet constituted prior to amendment. After that, existing tribunal, that is GSTAT, notified under 1A, which will be the NAA equivalent. Applicability of subsection 2 to 13, fully applicable to NAA, not applicable uses empowered tribunals rules. And last, effective mechanism, no appeals possible due to vacuum. Immediate appeals via interim forum would be available in itself. Practical example, I have already given it to you. Impacts also, I have just made it clear to all of you. So this completes the 6 important deductions, amendments which have been made in the GST law as of today in present budget 2026. To me, in the entire budget, whatever has been important so far as the manufacturer, the suppliers and other things are concerned, not the amendments which have been made in the direct taxes law, but the amendments which have been made in the GST law, which definitely is going to provide huge benefit to the persons who are involved in the activities of business in itself. So that is what the major issue that I just wanted to share with all of you in nearly about 1 hour's time in itself. And now let us move further to the railway corridor, the second topic that I just wish to bring it to your notice. The Union Budget 26-27 is talking about high-speed rail corridor between Mumbai and Pune and Hyderabad, aiming to revolutionize transportation in the region. Nobody understands what this railway corridor means all about. Nobody understands what does this Pune, Mumbai and Pune, Hyderabad ultimately talks about. Let us go into the details and try to find out what is this railway corridor all about. A railway corridor is a dedicated route for high-speed trains like bullet trains, designed to reduce travel time and increase connectivity between cities. This can improve the interaction as well as the interdisplay among the two cities in itself. The business also will grow up because the connectivity comparative will be on the smaller side. In this case, Mumbai-Pune and Pune-Hyderabad corridors will enable faster, safer, and more comfortable travel. So it is not the travel that matters. It is not the travel of the passengers that matters. It is the transfer, the travel of the goods that ultimately matters. And that is the reason why the business activity will improve the moment at which this particular corridors are being put in place in itself. Now, reduced time is the first important point of advantage of railway corridor. The Mumbai-Pune corridor is expected to take about only 45 minutes to reach Mumbai. Similar would be the case from Mumbai to Pune, while Pune to Hyderabad journey will be approximately in 1 hour and 55 minutes of time. I remember myself that when I was traveling by plane, I used to go within 1 hour and 5 minutes of time. If I travel by Air India, we used to reach by 50 minutes of time. But when I go by train, nearly 9 to 10 hours were being required. And if I go by bus in the night, if I sit by 10 o'clock, by 6 o'clock in the morning, after 8 hours of time, I used to reach Hyderabad in itself. See the miracle here. Within 1 hour and 55 minutes of time, you are going to reach Hyderabad. Hyderabad will be the next Bengaluru in the times to come in itself. Bengaluru, there is a limitation for expansion. Hyderabad has lot of potential to gear up the expansion in itself. And we need to see the Silicon Valley of India sooner in Hyderabad in itself. So that is how the things are being there. And that is the reason why this connectivity matters a lot so far as the technical things are being concerned. So keeping that particular point in mind, a major thing that what you are supposed to remember here is that this corridor is going to strengthen the economic ties between the major cities, which ultimately will be promoting business travel, logistics, and regional development in itself. Not only these two cities will be material, all the cities in between will be connected much more earlier than they used to be in the past in itself. So that is the entire area in the range of Pune, Mumbai, entire area in the range of Pune and Hyderabad, where the train ultimately will be moving into, will get blossomed up over a period of time is concerned. High-speed rail, it is about environmental benefits I am talking about. High-speed rail is a cleaner mode of transportation, reducing carbon emissions and road congestion. Because nowadays in Pune, we see that lot of activities are being there because of road congestion. Normally, we normally used to take only 5-10 minutes of time. We need to travel for another 15, 20, 25 minutes of time. Coming from Hinjodi is a Herculean task in itself. Normally, you take triple the time that what you normally ultimately anticipate. So this is what the situation is there. Getting crossing from the road now has become difficult. 12 storied buildings are there, but no infrastructural facilities are there in Pune, which is the drawback which we need to understand. But ultimately, this can improve over a period of time. Sooner or later, this ultimately, this road congestion from Pune to Mumbai and from Pune to Hyderabad can come down a little bit. So that is how the things are being there. With the help of trends, we can get this time reduced without any affection, without any, you may call it as any hurdle in itself. So economic growth will be the major issue that we'll have to look into by facilitating faster travel, connectivity. These corridors are expected to boost economic activity, create jobs, and improve the quality of life for residents in itself. Then disadvantages are also there. That high construction cost, developing those corridors requires 16 lakh crores of rupees from 7 national growth connector corridors. So 16 lakh means 16 trillion rupees, 16 crore trillion rupees are being required. Land acquisition is another problem that we need to look into. Then importance is also there, promote environmentally friendly transportation, enhance regional connectivity, support the growth of the industries and businesses in itself. So benefit to the residents are also there that we will ignore for a while. Then the last topic that what we need to make it out, how much time is there? Can you ask the Prasad? Because it's already 6:10 because I have already overshooted the time by 10 minutes now.
Yes, yes, you can continue for 5 minutes, sir.
How much time?
5 minutes is there, sir. After that, we are going to take the question and answer, sir.
No, otherwise you are going to have a session again?
Yeah, no, you just continue.
Okay, okay. Then should I conclude then just now? Because this will take another half an hour.
No, sir. So I think we have to conclude by 6:30 with question answer.
So then we'll conclude just now.
Okay. Yes. So there is a good question in the chat box. Same Mehul Mehta is asking, sir, can we take this amendment as now the commercial or financial credit note are done away with, meaning thereby now for issuing any show cause credit note, section 34 is applicable.
Sir, can we take this amendment as now commercial or financial credit notes are done away, meaning thereby now for issuing any credit notes, section 34 is applicable? Yes, you are right. You are right. Your presumption is also right. And that's a good way that personally I feel that is the way that we have to address, that is the way that we have to link it onto. But now since these have been made mandatory now, the option which was available earlier, that is not being available now. And now unless you have to claim the reversal of ITC, you have to ensure that credit note is being issued and recorded as well. So good point, Mehul, you have made. And your presumption or your thinking is in the right direction. Thank you.
Yes, it is a request to all the participants, if anyone facing any difficulty or you have any kind of doubt or any question, you just post in the chat box. Or you may raise your hand, you will directly unmute yourself and you can continue.
Even I can suggest that if you are not having queries at present now, you can just write it down and then the management can send it to me. I will address all of them and give you a writing answer to all of you. Should there be, because queries are only, there are 6 only amendments are there. Not much to think about it, only a question of understanding and getting the things done. Only some difficult points are there, but those are not likely to come now unless practicalities are being looked into. So as of today, only theoretical knowledge what we are having. Let us go into the details, find out what are the practical issues which are involved, and then we can think about that. So thank you all of you. Thank you for your patient hearing.
Thank you, sir. I have posted the email ID of our association, wmtp@gmail.com in our chat box. If anyone have any kind of query, you just write it down on our mail. We will share that copy to the Dr. Sadbhaisar and the answer will be communicated to you. And for the conclusion, I request the Joint Secretary of our association, Sri Kailash Kashid sir, to propose the vote of thanks for the entire session. Sir, please.
Thank you, Nandishwarji.
Good evening.
Respected dignitaries on the dais and online participants. Today's speaker, CA Suhas Bora sir and Dr. CA Dilip Sadhvai sir. Esteemed office bearers of MTPA and AFTP West Zone, dear members, delegates, and participants, a warm thank you to each one of you for making today's webinar on the Union Budget 2026-27 such an enriching and insightful session. We are deeply grateful to CA Suhas Bora sir for his comprehensive analysis on direct taxes and the practical implications of tax proposals for taxpayers and practitioners. Your clarity and examples helped us understand complex provisions with ease. A special thank you to Dr. C.A. Sadhvai sir for decoding the changes in GST and other major policy changes and broader economic implications of the budget. You are represented perspectives on growth, infrastructure, and sectoral developments brought valuable depth to our discussion. Our heartfelt thanks to the leadership of MTPA and AFTP West Zone, President of MTPA, Advocate Aniruddha Chavan sir, and Chairman of AFTP West Zone, CA Advocate Akshay Modi sir. Also thankful to Chairman of this course, Advocate Narendra Sonone, and Co-Chairman of this seminar, CMA Sripatji Bedarkar, for organizing this event and ensuring seamless coordination both on-site and online. To our attendees, your active presence, thoughtful questions, and engagement reflect your commitment to staying updated and serving stakeholders effectively. We hope today's session empowers you with knowledge to guide your clients and organizations with confidence. Thank you once again to everyone involved. We look forward to more collaborative learning events in the future. Thank you. Thank you very much. Over to Nanish.
Thank you, sir. We will share the PPT of both the session, the presentation. The present PPT was prepared by the Dr. Dilip Sadhvai sir, and that PPT will be shared in all the WhatsApp groups. And with the permission of the President of Maharashtra Tax Practitioners Association, Advocate Aniruddha Chavan sir, and All India Federation of Tax Practitioners in West Zone President, CA Advocate Akshay Modi sir, I formally announce that the session was concluded here, and we will stop here the session. Thank you very much for everyone for attending this session. Thank you, sir.